Well, hey there, it's Dan Bisig, and I'm here to introduce you to the College Aid Pro program, which I understand Arlette has given you access to. And personally, I think it's one of the best tools that you can use to both plan effectively for the financial side of how you're going to pay for college, as well as understanding how the colleges think you're going to pay for college. And so we're going to talk about the specifics on this program. I hope to help you understand a little bit better. So let me share my screen with you here. And we're going to take a look at a sample family. Right off the bat, I want to educate you about three numbers that are up top: your federal EFC, your institutional EFC, and your consensus EFC. EFC stands for your expected family contribution. You see, this is the dollar amount that the colleges will expect you, mom or dad, to pay for college. And we're not going to be able to get into a lot of details about the difference about how a married couple gets handled versus a divorced family. But what you do need to know is if you use this tool, you can absolutely get some clarity on both. Now, the federal is based on submitting your free application for federal student aid. The institutional and the consensus both use the CSS profile, which is an additional financial aid form that you have to complete in addition to the FAFSA. And so just keep that in mind. I'll show you in a minute the way that you can find out whether a college is strictly a FAFSA only school or whether they use the CSS profile. But the things that you're going to see on the left, so we're going to review this first of all. If you look over here on the left, we've got all the facts. So the parent's bio, meaning the parent's income, parent's assets, student's bio, the student's income, student's assets. All of these details need to be input first. Then we go into this thing called the pre-approval, which we'll talk about in just a minute. By the way, it's filling in right up top here in the right-hand corner. Then you put in the schools, which I've already loaded some schools into this demonstration for you. You also have the ability to look at the application deadlines, the kinds of financial aid or merit-based awards that you receive. You can plug that in here. Also, we're going to spend time in this how to pay. And then finally, at the bottom is going to be this private scholarship search tool. So this very first page is strictly mom and dad's details, okay? And in this case, I'm just saying that, the parents, one was born in 65, the other in 66. This is a married couple filing joint tax return. You can see that there's, separate as well in here. The kind of tax return that they complete should be a 1040 in most cases. How many are in the household? In this case, we're going with 4. And then definitely put your address and details in here because the program does look at whether you're an in-state student or an out-of-state student when it comes to financial aid and, in the calculations. So the next item is the parent's income. So for the sake of this conversation, I'm going to say both of these parents, that you both work, okay, that you actually are W-2 earners, but you could be self-employed. You could also put that information in here. And we're going to say that one parent makes, $100,000, and the other parent down here makes, say, $60,000. Now, in addition to that, we're going to say that one parent is actually contributing about $10,000 to their 401k plan. So your adjusted gross income in that case is going to be reduced by that amount. And I already know that on a $150,000 income, you're going to pay about $27,000 in federal income taxes. So when we come in here, what we also have is things like a health savings account, which you would need to put in. And by the way, I should mention, make sure that you grab your most recent tax return. It will help you a ton as you're filling these details in, because over here on the right side, there's this little notes tab. And when I open that up, notice what it does. This shows me exactly where to find these details. But as I mentioned, we already know that this particular parent has put $10,000 into their account. By the way, I forgot to mention something to you. Did you notice up top here that as I was plugging these income numbers in, that your expected family contribution was already being calculated, and that there's already a difference between what the federal looks like? So this is already saying that the parent contribution from income alone is $27,810. The program rounds it to 28. From the institutional and the consensus, it's about almost $22,000 for the parents, as well as the student is automatically expected to put in about $2,450, whether they're working or not, whether they're having any savings or not. That's the expectation of these schools. And so that's where we get the $24,000 numbers. Now, these are going to continue to change every time we make some modifications to this. In fact, if I, again, just to show you this, if I took out this dollar contribution here, watch what happens up top. See that? It dropped it to $23,000 and $20,000 up here. So again, we know that we need to put that in there because the adjusted gross income has already been impacted by that. So when we put the $10,000 in there again, it's actually going to bump those numbers back up again. So that's the income. Next, we're going to move on to the other asset items here, which is how much does parent one have in cash, savings, and checking? Let's just say that they've got $5,000 there, and we'll say that they also have investments. So look over here on the right side. The types of investments we're talking about are CDs, stocks, bonds, mutual funds, 529 plans. That's right, folks. If you have a 529 plan that mom and dad are the custodians for the benefit of the child, that's considered a parent asset. And so that does get included in here. You do not, in this particular screen, remember we're talking parent assets here. So you do not put anything like your child's accounts. So their checking account, their savings account, that goes in a different spot. You do include investment real estate or a second home that you've got. Those kinds of details do go in here. So let's say that the parent one has, oh, I don't know, $200,000 worth of additional assets. Now watch what happens up top here again. Okay, it's really important because the way that this works is from the federal methodology, it's going to increase by 5.64% above a small asset protection allowance that you get. And for the institutional, the consensus, it's going to go up by 6%. So those assets do make a difference. Now, how about home equity? Let's say that you've got $300,000 worth of home equity. Again, I want you to watch the numbers. What happens in this case? Well, from the federal standpoint, nothing is going to change because home equity is not considered an asset from the federal methodology. However, in the institutional, it is. And in fact, it had a bigger impact than even the consensus did. So you do need to know that every single college in this category, by the way, from the CSS profile standpoint, there's about 200 to 300 colleges and institutions that in addition to requiring the FAFSA, they also require the CSS profile. Let's also, say that maybe you've got a second home that has maybe $50,000 worth of value. Again, it's going to impact all three of these because that is considered investment property. And you can see how that increased your numbers up top. Now, let's just remember something. These three expected family contribution amounts up top are a per year amount. So if you're going to a school that only uses the FAFSA to calculate financial aid, so the free application for federal student aid, then they're expecting you to pay $42,000 per year. If it's just an institutional or consensus school, then it's going to be a differing amount depending upon how they consider your assets and your income. If you own a business, then you do need to put these details in here, but also realize that if it has less than 100 employees, it will not be counted under the current calculations. However, in other cases, it will be included. In fact, from an institutional standpoint and a consensus, it's always included. That 100 employee thing only comes in with the federal side of things. And then, of course, we've got other assets here, but none of these count against financial aid. So annuity values, your retirement accounts, 401 or 403B, traditional IRAs or Roth IRAs, none of those get counted in the formula. They're just here to help you kind of put everything together. So we've dealt with the parent assets. Now we're dealing with the children. So in this case, I've already plugged in a GPA, also an SAT score. I realize that you may be in a state and or applying to colleges that no longer require test scores, but if you're looking at applying out of state, it's very possible you will have to do this, even in this test optional world. Specifically, if you're trying to go for bigger scholarships, you often see that that's a requirement. Will this student in the future be a National Merit Award finalist because of how they did on the PSAT? Don't know, but that's something you could plug in their senior year. And then, high school graduation year, they're going to Happy High School. And in this case, we're just saying they have an undecided major at this point. Also, there's a second sibling. And so their graduation year is here as well as the same high school. Now, if they have some money, so if they've got $2,000, let's say in their cash and checking accounts or investment accounts for that matter, then we plug that in here as well. It really shouldn't probably have an impact, but if from the institutional or the consensus, it may, depending upon how much is there. They do count that as well as private tuition costs. Okay, take a deep breath. So we've gotten through the parent income, parent assets. We just finished the student's biographical information. Now we're going to go on the student's income. Here's the good news. Your student can earn up to $7,000. I'm going to use $6,800 without any impact on financial aid at all. So we're going to put the same thing here. We're also going to not worry about any income taxes because they're probably going to get most of that back based on that earnings. We're also not going to worry about them having any untaxed income. They're not putting any money into retirement. And if they are, by the way, good for them. Good for you, parents, for helping them to put money into, say, a Roth IRA or something. Then we're going to deal with the assets. Now, here's what you do need to know. Every dollar that is in your son or daughter's name counts against financial aid. And from the federal side, it counts at 20%. So if they've saved, let's say $10,000 here, then what we're going to see is the impact that that has on the financial aid calculator. You see what happened? That's the impact that we're looking at. In fact, if I open this up, you'll see that now of that $10,000, $2,000 of that counts against financial aid. That's the student's contribution at 20%. They also, maybe they've got some investments. I'm not going to worry about that for this illustration, but you get the point. You fill in all those details. It will, again, help you finish this. At this point, you now have what your expected family contribution is per year, per institution, depending upon which of these formulas they use. And so we're going to go into the next phase of this process, which is, okay, we understand what the colleges think that you should pay, but what can you really pay? And that's where we get into the nitty gritty here with this pre-approval amount. Now, from the beginning, based on the income alone, it's already said that you qualify for $2,500 a year. I'll explain that in just a minute. But let's say that you have $100,000 sitting in a 529 plan for this particular child. And let's say that you're going to continue to put $250 a month for the next 4 years into that 529 plan. So you can see what this does is it takes you up to $112,000 worth of assets alone in the 529 plans. In addition to that, you could always decide that you're going to give your student a little bit of extra spending money per month. I'm not going to worry about that right now, or even, just plan for cash flow that you're going to provide. But here's where that tax information comes into play. It's using the American Opportunity Tax Credit. If you're a single parent and make less than $80,000 per year, you can qualify for it. And if you're married, you can have less than $160,000 to get the maximum credit. Now, in addition to that, maybe your student's going to put some money towards their own college based on how they're saving money, based on their jobs. Maybe even grandparents are going to step in and help, or aunts or uncles. And if that's the case, you could put those details in here as well. But right now, based on what we have, the pre-approval amount that we've calculated is $122,000 that's available, or that breaks down to $30,500 per year that you have to pay for college. And this could be a great way for you to educate your student as to how you're going to step up and help. Because remember, if you're applying to a college that takes the free application for federal student aid, they're expecting 44. Well, you have $30,500 available. Where's the extra money going to come from? So let's go into and now look at, we've calculated the expected family contributions. We've calculated how much per year you can put in. Now let's go looking at some schools. And as I said earlier, I've already populated some popular schools in here. I'm going to hide these notes. And so you can see what we have in here. And we can see this is the overall cost of attendance for these individual schools. Pretty amazing, right? I mean, that it's almost $85,000 per year to go to Chapman, or, $86,500 to go to Harvard. If you look at Stanford, it's, almost $84,000 and so forth. Now, on the right side is what we're expecting based on these EFC numbers that you're going to be paying per year, at least the first year to go there. And so you can see these numbers are less. And so we want to understand that. So I'm going to go into Chapman for just a second here and show you some details. So Chapman is strictly a FAFSA school. And you can see they've got the total breakdown as far as, the total cost that they've got here. But what they also show you that's really nice is they also give you some details. So this school meets 76% of total need that a family has. And of that, 52% of that is going to be free money through grants. And they also give out some merit money to the tune of 18%, which equals an average of about $20,519. So in this particular case, this student is likely going to qualify for some merit-based money and or some need-based. So it's going to be an either or proposition as to how they're going to handle this. Okay. I also want you to notice on the left, there's some other great details here. When it comes to admissions, what's the GPA, the test scores, that they're a Common App school, also that this school is also test optional. And then it gives you some of the rankings. It also gives you their total enrollment. the percentage of students that they admit, from year to year, their graduation rate, which is their 4-year graduation rate, and then some other details if they're an early action school or early decision school. Also over here on the right-hand side, they give you some other details about what's the starting salary for a student who starts undecided, 1 year, the 5-year, the 10-year averages, so that you get a sense of that. And down here at the bottom, if this is a school that gives out merit-based scholarships, it also shows you what those different merit-based scholarships are. And in this particular case, what it has done is it's already highlighted the $25,000 scholarship that's automatic because of the SAT score and the GPA that the student has. So it's for an in-state or out-of-state student. Those kinds of details are there as well. So really, really good details for you to really plan accordingly for these colleges. Now, how about Harvard? Well, Harvard is an institutional methodology school. Again, there's their pricing, but notice this. They meet 100% of demonstrated need. And they do that 90% of the time with grants or free money. But notice this, they do not give out any merit-based scholarships. And so if your intent is for you to have your student qualify for merit scholarships based on their athletics, their academics, or their talent, you've got to know going into it whether or not they even offer those. And again, over on the left-hand side, look at their stats. That's pretty incredible numbers here, right? Even the fact that they're test optional, but, look at their rankings. In addition to that, look at their total enrollment, their admit rate, which this last year was below 5%, their 4-year graduation rate, and the fact that they do have an early action deadline that's available. And then finally, again, here's those income numbers that we were talking about. But just to prove this to you, if I come down here, notice the program doesn't go any further because there are no merit scholarships to take into consideration. So again, I want you to spend time in each of the schools that you pick and really look at those details. It's really going to make a difference for you. And then decide which ones you're going to apply to. In this case, I selected them all. And there's a reason for that, because then you've got the ability to hop in here to putting in the specific details that you need for each of the schools when it comes to their applications. This is also work, again, that you're going to do with Arlette. When you ultimately get those financial aid awards, what's it going to look like? And then you can break these details down. Here's a part of the program, though, that I really love, which is this is going to offset or reset itself. But this has every single one of those same colleges listed here. But then what we can do is we can go in and make some plans as to how you think you're going to pay for the school. Here again is the total breakdown of the cost of attendance, right? By the time this particular student gets there, it's almost $85,000 per year. In this case, because the student qualified for merit scholarships, they got that over the need-based, but that then takes that off of the cost. So what we've got then is this gross amount, less the merit scholarship, still leaves a shortage of almost $60,000, or a grand total over 4 years of $252,000. Now, how are we going to pay that? Well, we've already said that there's this pre-approval amount, which we've talked about, the 529 plan money, and also the American Opportunity Tax Credit adds up to $30,500. So let me shrink that back down again. So if we take the net cost minus the pre-approval amount, now we have a funding gap that exists. And then we have to decide how we're going to cover that gap. Well, in this particular case, I'm already showing you the fact that your student could go ahead and use the federal loans. So they've got $5,500 available to them the freshman year, $6,500 sophomore, $7,500 junior, $7,500 senior, for a grand total of $27,000. However, you also could look at additional private student loans, federal direct loans, a home equity line of credit, or other loans that you might want to consider. All of those could be factored in here, not to mention, again, in the pre-approval, is there a way to find other help, from the grandparents? Maybe they're sitting on the sidelines until they know what the shortage is going to be to see how much extra, their grandchild needs to help pay for college. Again, total transparency so that you can have a great conversation with everybody involved. In this particular case, if we take those loans into consideration, we have a total shortfall of almost $24,000, right? But then every year we've got that additional shortfall, which means that at the end of the day, we've got an additional $103,000 that we need to come up with, plus the amount of loans that the student already took out. That's why with this program, what it does is it adds these two together and it brings them right up here to the top. So that what we're looking at here is a traditional 10-year loan repayment, which is $1,445 per month, or a 25-year income-based repayment program, which is $839 a month. That's where it starts off at. And so, just tries to help give total transparency again for your family, and also an understanding of, hey, if you're, making that first year of income, your estimated monthly take home is going to be about $3,700 compared to these. I mean, that's a big chunk there, right? $1,445 out of that if the student's 100% responsible for it. Now, if we want to find additional money to help pay for college, there is, of course, these private scholarships that are down there. And that's why this is going to be the last thing I'm going to show you in this calculation. There's a separate program built into this, which actually calculates or allows you to calculate private scholarships. And it's based on residency, civic organizations, the area study of the student, the institution itself, the type that they're going to, their ethnicity, religion, military, if they're in the military, and then the amounts that they're looking at. There's 164 pages of private scholarships involved in this. And so again, it's a great way for your student to be involved in the process, and also for them to find additional resources to help pay for college. Bottom line, folks, this is a terrific tool for you to have a great conversation as a family about how you're going to pay for college. And also, if cost is a factor, which it is for everybody, I don't care whether or not you can pay the full price or not. Everybody wants to pay as little as possible for college. But I would encourage you to use this tool to very effectively be able to run the numbers and then dive into the schools that you're working with our lead on, so that you guys are all on the same page. I hope this has been helpful. I know it's a lot of information, but I've tried to simplify it as best I can. And I wish you the very best as you go through this process with Arlette. Take care now.